2021 has been an exceptionally good year for the stock market overall, despite the virus, whose name we shall not mention, still looming over our heads. And as we are entering into the new year, it is a perfect time to reflect on which stocks and ETFs were both the best and worst performance of the past year, both to see if you and I managed to be lucky enough to hold some of these top performers in our portfolios. Wow. And to figure out why it is that some performed better than others. So in today's video, I'm going to show you who the 10 best and 10 worst performing stocks and ETFs in the US market was for 2021, and I will give you my interpretation of why I think these companies and indices performed the way that they did, and at the end I will also give you my predictions of which companies and sectors I believe might perform the best for 2022. Think of this video as being the Dundies Awards of the stock market for 2021. And if you didn't understand my reference just now, then we cannot be friends. Just kidding. Go and watch The Office. You will thank me later. Hey! Now the data that I will be sharing was based off the Easy Equities platform and stretched from 3 January 2021 to 3 January 2022. So hold on to your chair and be ready to be rocked by some crazy numbers. So let's start with the top 10 performing ETFs in the US market. Coming in at number 10 is the iShares S&P 500 Growth ETF with a performance of 33.13%, followed by number 9, which is the Vanguard Financials ETF with 34.44%, the iShares S&P GSCI Commodity Index Trust ETF in number 8 with 39.87%, the Vanguard REIT ETF in number 7 with 41.13%, the Van Eck Vectors Semiconductor ETF in number 6 with 41.19%, and then moving on to the top 5, the SPDR S&P Semiconductor ETF in number 5 with 43.18%, the iShares Core US REIT ETF in number 4 with 44.61%, the Vanguard Energy ETF in number 3 with 48.86%, the SPDR S&P Home Builders ETF in number 2 with 51.07%, and then taking the top slot for the best performing ETF in the US for 2021 is the ProShares Ultra S&P 500 ETF with a performance of 64.89% for the year. Now let's look at the the 10 worst performing ETFs in the US market. Coming in at number 10 is the SPDR S&P Biotech ETF with a performance of minus 20.65%. This is followed by the iShares MECI China ETF in number 9 with minus 22.88%, the ARK Innovation ETF in number 8 with minus 23.93%, the Global X Silver Minus ETF in number 7 with minus 25.39%, the ETF MJ Alternative Harvest ETF in number 6 with minus 25.44%, and moving to the worst 5, the short QQQ ProShares ETF in number 5 with minus 25.8%, the iShares Global Clean Energy Index Fund in number 4 with minus 26.26%, the iShares MECI Global Silver and Metals Minus ETF in number 3 with minus 29.63%, the ARK Genomic Revolution ETF in number 2 with minus 34%, and then the US ETF DERP for the year award goes to the ProShares Ultra Short S&P 500 ETF with a horrid performance of minus 44.2% for the year. Alright, so next let's look at the top 10 performing stocks in the US market for 2021. Coming in at number 10 is 3D Systems Inc. with a performance of 105.7%. This is followed by Umbrella Inc. in number 9 with a performance of 122.0%, Nvidia Corp in number 8 with 124.5%, Moderna Inc. in number 7 with 128%, Ford Motor Company in number 6 with 144%, and then moving into the big leagues, Range Resources Corp in number 5 with 150.2%, Asana Inc. is in number 4 with 157%, BioNTech in number 3 with 200.4%, Antero Resources Corp in number 2 with 209.5%, and then the overall stock winner in the US market for 2021 is Peabody Energy Corp with 242.52%. And then lastly, let's look at the 10 worst performing stocks in the US market for 2021, starting with Invitae Corp in number 10 with a performance of minus 65%, followed by UHA Inc. in number 9 with minus 66.2%, Stitch Fig Inc. in number 8 with minus 66.4%, Canopy Growth Corporation in number 7 with minus 66.6%, Jumia Technologies AG in number 6 with minus 68%, Webshop Holdings Limited in number 5 with minus 70.3%, IQIYI Inc. in number 4 with minus 74.7%, Peloton Interactive Inc. in number 3 with minus 75.4%, Workhorse Group in number 2 with minus 79.65%, and then the overall derp stock for the US market in 2021 award goes to New Oriental Education and Technology Group with a staggering performance of minus 98.8%. By the way guys, I made an Excel spreadsheet where I listed the 1-year performance of over 115 ETFs and 440 individual stocks in the US that I will link to down in the description if you want to check it out free of charge. As you can imagine, this took me a really long time to make, so if you found it to be helpful, then please clap that like button so that this video can spread to more people. This really helps my channel out a lot and I would really appreciate it. Thank you. Alright, so let's talk a bit about what happened to the markets in 2021 that may have influenced the performance of some of these ETFs and individual stocks. First off, although 2021 has been a wild year in many respects, the stock market turned a solid performance, seeing that the S&P 500 gained 28.7%, the Nasdaq 100 gained 27.5%, and the Dow Jones Industrial Average gained 20.9% for the year 2021. Now, right off the bat, when looking at the top ETFs for the year, it is clear that the real estate, technology, and financial sectors outperformed the rest by quite a decent margin. So why is this the case? Well, it's mostly due to the aftermath of the effect of the pandemic of 2020. People were still locked in their homes and needed a way to continue to work and to connect with each other. Hence why the share prices of innovative tech companies that helped other companies and individuals to adapt to the ever-changing landscape of the pandemic soared throughout the past 2 years. Many people lost their jobs and had to cut back on spending in order to survive. This caused the Fed to release stimulus packages in an attempt to prevent the economy from collapsing. They also kept interest rates really low, and this meant that growth stocks, whose valuations are mostly based on future earnings, performed exceptionally well, as they tend to do when interest rates remain very low. Investors also sought protection from potential rising inflation, and thus they turned to real estate and the finances sector, as both had strong historical returns during periods of elevated inflation. Now, because of the supply chain pressures brought on by the pandemic and the rising price of energy brought on by the surge in oil and natural gas prices, inflation in the US hit 6.8% for 2021, which was the highest it has been since 1982. This punished short-term investments like the bond market, as US Treasury ETFs were not able to provide an acceptable level of returns that can keep up with the rising rate of inflation, and these thus actually create capital losses for its investors. This caused many investors to pivot away from safe government bonds to higher risk, higher return assets such as shares and real estate, in order to try and preserve the value of the investments by seeking returns that will either beat or at the very least match the rising inflation rate. And as more money was pushed into the stock market, the demand rose, and this caused the overall value of the stock market to shoot up. Now, there were also a couple of things that happened that could have derailed the stock market completely, including a contested presidential election, an assault on the capital, historically high inflation, supply chain disruptions, naysayers who forecasted a correction that never really appeared, and of course, let's not forget the raging Goga, whose name we will still not mention for the YouTube algorithm, and his two nephews. But none of these events even remotely stopped some stocks from notching all-time highs. In fact, the S&P 500 notched 70 all-time highs in 2021, a record that is second to only 1995. The world also responded fairly well to the pandemic by the rapid development and widespread deployment of vaccines, which stimulated economic growth and kept the market strong despite the discovery of these new variants. Alright, so now that we looked into the past, it is time to talk a bit about what we might expect to happen to the stock market in 2022. The US stock market has been on an exceptionally strong bull run in the past 3 years. The S&P 500, for example, had its best 3-year performance in more than 2 decades, thanks to its double-digit returns for 3 years in a row. But if history is any guide, 2022's gains may be less impressive, though not necessarily poor. The S&P 500 has notched 3 straight years of double-digit returns 9 times since 1928, and gains in the year following such periods had on average been weaker, with the index averaging 8.4% compared to its overall average total return of 11.6%. So why would this be happening? Well, in order to prevent inflation from going completely out of hand, the Fed is planning on bumping up the interest rates 3 times during 2022. Why? It all has to do with supply and demand. When interest rates are low, people are likely to borrow more money to buy stuff. This increases the demand, and thus the price will go up, especially when there is a limited supply. This makes the costs of common goods and services to go up, and seeing that inflation is mostly based on the consumer price index, which tracks how much the price of common goods and services change year by year, this will in turn increase the overall inflation rate. Now, a fairly simple solution to this is just to reverse this whole process by increasing the interest rates in order to make it more expensive to borrow money to buy stuff, with the hope that the demand will go down, thus pulling down the overall price of common goods and services, and therefore bringing inflation down to acceptable levels. So what does this mean for the markets? Well, this will most likely drive up bond yields, because remember, bonds are just another fancy way for the government and companies to borrow money from investors, and if the interest rate goes up, then the interest rate on debt also goes up, and this will therefore increases the bond yields. And this is bad for riskier assets such as stocks. Firstly, investors might pull out some of the capital from risky assets in the stock market to put it into more safer, predictable assets like bonds, therefore driving the overall demand for stocks down, and in essence also bringing their price down with it. And secondly, the share prices of many growth stocks might actually get pounded, as some of them already are, because their valuations are mostly based on future earnings. This means that when companies focusing on growth are valued in order to determine their share price, the majority of their valuations are based on what they might earn in the future. Now, if interest rates goes up, it will be more expensive to borrow money to fund their growth, hence their valuations will also be reduced. And seeing that most of the biggest growth stocks in the US are already overvalued, this can bring their prices down quite dramatically. Now I'm sure you can see that broader markets such as the S&P 500 could potentially be in a lot of trouble if behemoth growth stocks like Microsoft, Apple, Google, Nvidia, Tesla and Meta platforms falter, as these 6 companies alone accounted for about 1/3 of the S&P's total return in 2021, and between April and early December, just 5 of these stocks accounted for 51% of the S&P's returns. And seeing that we are most probably past the peak of the post-pandemic rebound, most experts expect value stocks to outperform growth stocks that previously soared on future growth expectations. On another note, the pandemic has continued to reinforce the importance of ESG engagement, with many governments and corporations pledging at the United Nations Climate Change Conference to shift away from fossil fuels towards more sustainable renewable energy sources. So I believe that the ESG sector will be very interesting to watch in 2022 and for the majority of the next decade, as the world is uniting to move towards stronger environmental, social and governance principles. So in summary, as most experts expect the performance of the markets in 2022 to be more focused on value stocks, innovation and environmental sustainability, some of the biggest jewels may potentially be hidden in the small caps market, especially within the emerging market sectors, as this sector gives the most exposure to the next generation of innovators and disruptors at fairly attractive relative valuations. Now obviously, as we all know by now, no one can accurately predict the future, especially when it comes to the markets. But I do believe that this will be a very interesting year, as our focus will most probably be moving away from the usual overvalued growth stocks towards the more exciting undervalued underdogs that are scattered amongst the thousands of small cap companies, making individual stock picking even more challenging, but potentially a lot more rewarding. But for the average investor, sticking to a well-diversified index fund or ETF, maintaining a long-term outlook, and ignoring the short-term noise will continue to be a good investment strategy, as it's been proven time and time again in the past. I will personally continue to allocate the majority of my investments to broad markets ETFs like the VWRA and the S&P 500, but just because I am very analytical and extremely curious, I might dabble in the dark arts of individual stock picking to see if I could potentially beat the market. This will be a completely new area for me to enter, and I am 100% aware that I will most probably fail, but I will happily share everything I learn on this channel, both my wins and my losses. So if you guys are interested in videos that are more focused on individual stocks, then please let me know down in the comments. Now, in next week's video, I will also share the top and worst performing stocks and ETFs on the JSE, and I will also give you my predictions for the South African market for 2022. So if you are not yet subscribed, then make sure you do so that you won't miss out. Lekker!